put everything in perspective. So, ever since we embarked on economic liberalization, so prior to taking up economic liberalization, which was after the crisis we had, foreign exchange crisis we took early 90s, major economic liberation was taken up in the country, where you had complete dismantling of licensing. You opened up the the country to trade and investment. That means your FDI policy started becoming more liberal. Your tariff, non-tariff measures were made more conducive for free flow of goods and services for foreign trade. So this has been happening, but we still have maintained ever since independence exchange controls. So you know that in 1947 we had the Foreign Exchange Regulation Act. So a lot of restrictions were put on foreign ownership, on convertibility of the Indian rupee, etc. After undertaking economic liberalization, it was felt that unless we have financial globalization along with economic liberalization, we may not be able to get the full benefits of liberalization. So these efforts, you are all journalists, you are fully aware, these efforts have been underway ever since then. So in '96, RBI had constituted a committee which is known as the Tarapur Committee 1, which looked at the situation and said that it is very important for us to move towards full capital account convertibility. That means to internationalize the rupee as a currency, to be able to attract foreign capital and to be able to have greater efficiencies in the financial market. They said that there are preconditions to this are that you should have a good financial foreign exchange reserve, inflation should be under control, fiscal deficit should be under control, external debt should not be too much, and so on and so forth. That means main macroeconomic stability requirements are necessary, because if you don't have foreign exchange reserves and you make your currency fully convertible, you will immediately hit crisis. So there has to be some good reserves, etc., and then you can make it. But then you had the East Asian financial crisis in 1996-97, and Korea and all were badly affected. But India was saved. India was not affected. One of the reasons India was not affected was that we had not plugged into the global financial system. So it was felt lucky we did not plug into the global financial system. Otherwise, we would also been exposed to these economic vulnerabilities. So this went to the back burner. But simultaneously, what we did is, in a calibrated manner, we opened up our capital market and we opened up our financial market. How did we open up our capital market and financial market? In the capital market, in '93, we allowed foreign investors to access Indian capital market through foreign portfolio investment route. We allowed foreign direct investment route. We allowed foreign banks to take licenses in India and do intermediation, to do banking. So, though we maintained restrictions on capital account convertibility, we liberalized it to some extent. For example, today, current account transactions, there are no restrictions. Capital account transactions, there are restrictions. You can't acquire immovable property. Okay. So, and under external commercial borrowing, there are some limits. So, these limits were kept. 10 years after Tarapur 1, Tarapur 2 also when they did, then also the committee reiterated that it is very important to have full convertibility in a phased manner, and going forward we should further liberalize ECB. So ECB restrictions came down. Non-resident investors' engagement with Indian capital market also was made more liberal. Some such efforts were made. That is the time when you also had a Percy Mistry committee in 2007, which said, which looked into the whole issue of an international financial services center also. It looked at, for the first time, an international financial services center concept also. And it found that though we have a well-developed financial sector, we need a heavy dose of financial sector reforms. The sector is good, but some of the regulations are a little outdated. They bring in a lot of inefficiencies, and market determination is limited. So it should bring in better ecosystem, and some reforms are required. Second, it felt we should not fragment the financial sector into insurance, banking, capital market, pension. We should have a unified regulator because all these segments are interconnected and many places they overlap. You do not know whether it's a security or it's an insurance product. There are so many things where there is overlap. So if there is one unified regulator, the regulator can have a proper coordinated approach and see that these frictions between two regulators is minimized. And third was that you should have ease of doing business. So if a foreign investor comes, it should not become very difficult for the foreign investor to comply with your regulations. Sometimes it is felt that our regulations are very, very onerous, too many requirements are there, so they feel, what is the... Now at that time exactly 2008 crisis came, global financial crisis. Again this got us head back. But mind you, from 93 onwards continuously some reforms are taking place. It is not that reforms are not taking place, but big have not taken place. Big bang. Now a considered view was, instead of exposing the whole of the country to risk, can we have a dedicated financial corridor which will be like an international financial center, and it will be the gateway for foreign capital to come in and for foreign capital to go out. This is a unique experiment in the whole world because we often make the mistake of treating this similar to Dubai or to Abu Dhabi or to Mauritius. No, Dubai, Abu Dhabi, Mauritius are basically financial hubs, more of tax havens, offshore financial centers, which are trying to export financial services. That means first attract talent by having good infrastructure, good lifestyle, etc., and then try to process and export financial services. They do not have their own large economy. They do not have their own economy. So these, you can't compare Dubai and Singapore to India. Rather, you can say that India has contributed significantly to the growth of Dubai and Singapore as financial centers because India is procuring its international financial centers from international financial services from Dubai and Singapore to a great extent. So we now, then if you even look at Hong Kong we are very close because Hong Kong is the gateway to mainland China. But you know, Hong Kong wasn't Great Britain. It's only later that that treaty was over, then Hong Kong got transferred to China. And China had a ready-made international financial center. And they intelligently used it as a gateway to deal with mainland China. Otherwise, China has complete capital account control. China has complete capital account control. But on another track, China has the CNY and CHY. Renminbi, international renminbi can be traded in Hong Kong. Chinese renminbi can be held by foreign investors also. But in India, you can't hold INR outside India. Okay. This is the backdrop to understand why we have set up GIFT IFSC and why it is a unique experiment in the whole world. We are doing a greenfield international financial service center. This did not come to us by legacy like China got Hong Kong. We are creating our own system. By creating this IFSC, the first objective is to see where all India-related transactions are happening and can they be brought back to India. I'll give you an example. Today, reinsurance. Most of the reinsurance is Somebody is giving direct insurance, that direct insurer is taking insurance. So it is reinsurance. That insurer is taking insurance on his risk, to cover his risk. So that is reinsurance. All this reinsurance is happening outside. ECB, external commercial borrowing. Most of these loans, etc., coming from overseas. Because dollar can be purchased overseas only, competitive rates. You can't have dollars in India. So Singapore, Hong Kong, London, New York, even Indian banks went to Singapore, Hong Kong, New York, and started lending to Indian corporates. So SBI in London, SBI in New York, it is able to get dollar from the market and give loans. So whether it is ECB, aircrafts, leasing, all aircrafts are coming from Dublin. Today we are fastest growing aviation market. Okay, third largest in the domestic, and we are also becoming third largest in the combined domestic and international. Very rapidly it is growing. But all the aircrafts are coming from Dublin, Ireland. Can that happen from here? Ship leasing, it is happening outside. All the fund intermediation, pooled funds, alternative investment funds, it is happening outside. So we are trying to get all those things here. How will we get it? We'll have to be able to attract those institutions to come here and set up business. Why will they come here? There has to be a good reason for them to come here. I can't issue a diktat saying that all of you come here. They will not come. So we have to become attractive. How will we make them attractive? So one is, if you are in Singapore, what are you getting in Singapore? To what extent we can match it or better it? Here you must see there is a differentiation. We can't match these overnight in terms of lifestyle, infrastructure, though infrastructure is very good here. But in terms of quality of life, in the way we understand foreign countries, all efficient systems, market infrastructure, physical infrastructure, job opportunities, educational facilities, all these are of very high standards. So people, like a lot of Indians today, majority people in Singapore who are running the finance sector are Indians. Maybe 70-80% are Indians. They have gone from here. Indian companies, startups, all the startups, unicorns, you don't realize, most of them when they become a unicorn, they flip to Singapore. They flip to Delaware. Because the investor who's putting money says, no, India, rules, regulations, problems. Head office, the holding company will be in Singapore. Holding company has all control. So the idea is, how can we stop the flipping? Otherwise, what is the use? You are saying you are having 100 unicorns or whatever unicorns, but then if they are all flipping outside, it's not good. We should get them here. So we are creating this facility, this ecosystem, trying to bring in good tax regime, competitive tax regime, trying to bring in very good regulatory regime, best-in-class regulations, okay, and trying to have very high level of, friendly business practices here, ease of doing business, so that, and there is the advantages of low cost, there is an advantage of tax certainty, there is an advantage of being closer to your investment. Traveling is not a problem. Even if you have to travel to Singapore or Dubai, it's a travel visa. Here nothing is required, no visa, nothing. You can just catch train tomorrow, bullet train, anything, come, do your business, go. So we have now put the regulations in place. Government of India has given very good tax regime, tax holidays, concession, 10 years out of 15 years, GST, all these commodity transaction tax, security transaction tax, all these concessions are there. So these concessions are matching the concessions they get there. Of course, one concession like Dubai gives no personal income tax. We can't give. There are certain things we can't give. But try to understand the difference. You see, one of the attractions of India is the opportunities in India. So even if we can't match them in personal income tax or social infrastructure and all, as on date, maybe 10 years from now, everything will match or exceed. But today, very difficult to immediately match. It's difficult. The attraction of being close to India and, get this sort of India is good enough for them to ignore those things and say, hey, let's come. As a result of this, today you have I think 10 foreign banks, 9 or 10 foreign banks which have come, their balance sheet size shows that they are heavily, banking on and betting on the India growth story. They have all come. Funds have come in a big way. Okay. Reinsurance is taking roots. It's now coming. Capital market also it is looking up because some major initiatives like the Singapore Connect, the SGX, NSE Connect, by June end it will be fully done. This will be one major project where at once about 10 billion open interest, 10 billion USD open interest will come here. What happens once that sort of thing comes, then it's possible to get volumes for other products also. Today the INX and the other exchange have some products. Have you visited those exchanges and all? Have you visited the INX and NSE exchange here?
No.
All right. Anyway, they are all state-of-the-art exchange. You see, we have international exchange, we have international depository, we have international clearing corporation. All systems are there, and it is all USD, no INR business here, no FEMA, full convertibility. So those advantages are anyway there. So by doing all this, we have been able to create the basic ecosystem and basic attraction for foreign institutions to come here, and for Indian institutions who hitherto were going outside and setting up shop to come here. Now, in the last 2 to 3 years, after a dedicated, unified regulator has come, I think the progress has been encouraging. I have to use measured words because after all COVID was there. And not only COVID, for international or global investor to start having confidence in a new jurisdiction, it's a tricky thing. It takes time. A new jurisdiction, is the regulator competent? What is the certainty? Is there certainty that this will sustain? What complications will be there? All these issues will be there. So today it appears that it has been able to establish itself as a credible regulator in the eyes of the global investor, because we are able to see encouraging movement. Volumes are picking up slowly, but good players, big names are coming and setting up shop in the gift IFSCA. So I would say that this is something you will have to understand as part of our Atmanirbhar Bharat concept. When Atmanirbhar Bharat concept was enunciated by the Honorable Prime Minister, he cautioned people, don't mistake this to be import substitution and self-reliance of the olden days. In olden days, we had this concept of import substitution and self-reliance. So you had the DGTD, etc. कि import नहीं करना है, only those things you cannot manufacture, only that you should import, etc. So many restrictions. This Atmanirbhar is 2.0. This Atmanirbhar is saying not only we will become self-reliant, but we will plug into the global supply chain and supply to others also. Like China. You are self-reliant to meet your own demand. Your own demand is so big that you will have the critical mass and economies of scale that you can become competitive as an exporter also. So the idea is, your primary objective is that, I am using the word leakage loosely, whatever is going out of this country, which could have been done here, I am taking it as leakage. Why don't you plug that leakage and see that all that business develops here, all those volumes develop here, ultimately all those tax revenues will come here, all those employment opportunities will come here. So, I would say that this is a silent revolution. It is one of the deepest financial sector reforms, and it will lead to massive economic transformation. But it is something which will take time, because in the life of a financial center, 1 year, 2 year, 3 year is not sufficient. It will have to, a virtuous cycle has to be done so that everything is feeding into it and it will keep on growing. I think broad I tried to cover the broad story of the economic rationale, how we